Well, welcome to my studio here in fabulous Las Vegas for our next lecture, which is the primary market for corporate securities. Been kind of fun to carve it up in a way, all this information content in a different way than other folks have done it. So that means I'm not having to follow a flow of a book or somebody else's slide deck. So, and these are meant as supplemental resources for you and other arrows in your quiver, so to speak, besides, your Kaplan or Past Perfect or STC, whatever the case may be. So make sure you like, you subscribe, you share on these. I'm trying to get better on my social media. I'm kind of new at it, so I'm still new at the slides. Somebody told me in the last lecture, my video feed is, even though I move it out of the way, is blocking some of the questions. So I'm still learning. Until February of last year, I only used a dry erase board. So getting better though. Dug up a picture here for us. So, my plan is once I get all the videos up, video lectures up, is to circle back and, fine tune and correct some errata, so to speak. There's nothing major. If there was material, I would pull it down and redo it, but keep those suggestions coming, like that one. And if you have some expertise, I've learned more from my students this year than any other year. So if you have some expertise about how to do that, I'm sure I can Google and figure it out for the next lecture. But so I apologize in advance if my video feed is showing up and blocking some of the slide. I'll try and avoid that. I thought that when I move it around, it also moves on the recording, but it doesn't. Anyways, the primary market. President Roosevelt, Franklin Delano Roosevelt, FDR, all that legislation was called the New Deal. And that means the old deal must have sucked. The old deal was not bueno. And two major pieces of that securities, of that New Deal was 33 and 34. They were companion pieces of legislation. So as you see here, President Roosevelt is signing this legislation, and 33 was signed in December, and they knew Congress would come back, and President Roosevelt would sign 34 in January. And so they were companion pieces. Some people say, well, Dean, how could we have an S1 that gets filed with an SEC if they didn't exist? Now, 34 created the Securities and Exchange Commission. And a lot of President Roosevelt's New Dealer friends were really upset that he made Joe Kennedy the first chairman of the SEC. They said, how could you put a, fox in charge of the hen house? And he said, well, who better as a gameskeeper than a reformed poacher? He knows all the games and he's going to shut them down. The securities industry was opposed to both pieces of legislation. And President Roosevelt said, you guys will thank me later. I know right now you're upset, but later on you will thank me for changing your industry. Almost every other industry is caveat emptor, let the buyer beware. But President Roosevelt said, I'm changing your industry through this legislation, and it's going to be let the seller beware. We, the seller of the security, have to make sure that we've done it correctly. Now, 33 is known as the Prospectus or Paper Act. 33 basically says if you're going to sell brand new securities, what kind of securities, brand new, to the public, you have to make a registration statement. Hence the term registered securities. So there's two types of securities: registered securities and unregistered securities. Securities have not gone through this process that we're going to be discussing. 34. Sometimes you can get 34 right by covering up the screen and saying, are they asking about paper prospectuses? 33. Are they asking about people and places? 34. People and places is 34, right? That's the, Reg T. That's, things we shouldn't do, unethical behavior. That's about, exchanges and all those things we used to get away with, all the kind of games we used to get away with. So today's discussion is primarily about the Prospectus or Paper Act, the Securities Act of 1933. And as I said, 33 is about selling brand new securities to the public. And, under 33, there are some exempt transactions and exempt issuers. So, by the way, this discussion is learn it once, get tested thrice. What I mean by that is this is on almost every exam. So this will go into the playlist on almost every exam because, this is appropriate for everybody. In fact, I've actually pulled some practice questions that come from the FINRA practice final, SIE practice final, that are appropriate for, 65 and 6s and 7s and everybody. Usually 7's just a little more depth. So primary versus secondary market. So, when the issuer receives the proceeds, let me get a text box here. That's called a primary transaction. And all those primary transactions together are called the primary market. And when the issuer receives, or the previous owner receives the money, that's called a secondary transaction. And all those transactions together are called the secondary market. I think a good analogy is the art market. Gauguin is not getting $25 million for the painting. The $25 million is going to the previous owner. Gauguin got $30 from some tourist in Tahiti, right? So now there are certain circumstances, in the types of deals we're going to be discussing. We have a primary distribution or offering. Sometimes we have a combination deal. And what that means by combination is that some of the stock being sold is newly issued stock, authorized but unissued. Now the company is issuing it. And some of it is the existing shareholders selling some of their stock. And so a combination distribution or offering is both primary and secondary. Now be careful. We're putting this in, this is different than a secondary transaction. It is a secondary transaction, but we're using the process of 33 to, liquidate some shareholders, take some shareholders out. So combination distribution offering is both newly issued stock and previous shareholder stock. And sometimes the issuer will shut up. None of our existing owners are using this offering to cash out of this thing. Most obnoxious combination deal I can recall was $160 million offering combination. $5 million of that was going to the issuer. $155 million of the 160 was going to the existing shareholders who were selling their shares. Now that was a follow-on offering, an additional public offering. And, I think they only tagged the $5 million on there, so they could say it was a combination deal. They could say that some of the proceeds is going to the issuer and some of the proceeds are going to the company. Now, I don't blame them, because for the insiders to have dumped that much stock under 144, it would have taken them forever. Because remember, under 144 from previous lectures, I would refer you to the secondary market lecture. I'm pretty proud of that lecture. I mean, not in terms of my ability to make slides, but in terms of content. But I have that 144 in there for you. And by way of reminder, that's 1% of the outstanding shares, the average of the last 4 weeks trading volume, whichever is greater in a 90-day period. And that would take them forever to dump that much stock. Now, we sometimes use the prospectus, this kind of process we're going to be discussing, where the entire proceeds, all of the proceeds, are going to the previous owners. For example, we use this process in initial public offering, but it's really not new stock. One of my ones I wasn't a fan of, you can see I'm kind of prejudicial about these. Previous owners cashing out, previous owners selling, was the Hyatt hotel chain. That was a $1 billion IPO, but not $1 of that went to the Hyatt hotel chain. 100% of the proceeds went to the previous shareholders, which were the Pritzker family. The Pritzker family was cashing out, right? You'd be entitled to know that. The In-N-Out Burger in California is privately held. The Snyder family owns most of the stock. And if they went public, you'd be entitled to know if that money is being used to build In-N-Out Burgers across the country. We're going to expand. Or is that money being used to cash out the Snyder family, right? Fidelity, 60% of Fidelity is owned by the Fidelity employees and 40% is owned by the Johnson family. And you'd be entitled to know how much of this is actually Johnson families cashing out and how much is being used to build the business. To be honest with you, if Fidelity ever did go public, my guess it would be a secondary offering, because I don't think they need any money for the business. And, in terms of estate planning, maybe, the Johnson family wants to get some liquidity. Sometimes we refer to going public as a liquidity event, particularly for the people on the stock. Anyway, so those are some types of offerings that we'll be discussing in today's lecture on the primary market for corporate securities. I pulled this from FINRA's practice exam. I'm a big fan of that practice exam. I highly recommend, if you're an SIE candidate joining us in this lecture, that you must do that practice exam. I've explicated that in a video lecture, where hour and a half or so. I think I walk you through each question and talk about the right answers, and more importantly, the wrong answers, why they're wrong, why they would have been right. And so I pulled this one. These questions I pulled from that practice exam are appropriate for all parties. So if this is in your playlist and it wasn't appropriate, I wouldn't be putting it there. So I'm telling you, if you're Series 7, you go, oh, this is SIE. Why isn't he putting an SIE slide here? It's a performance opportunity on all exams. This just happens to be their phraseology. All right, so which of the following comparisons, they love comparisons on all these exams, best describes the essential difference? So now let's see, I hope, I forget who it is. I think it's Get It Done who told me my video. I just moved that. Hopefully it moves on the recording. I'll figure out how to do that. I just moved my video camera. It shows me out of the way of the question. But anyways, which of the following best comparisons best describes, which of the following best describes the essential difference? They love that. Compare and contrast on the test. They just love that. Between a primary distribution and a secondary distribution. Now be careful. We're not talking about a traditional secondary transaction on NASDAQ or New York. No, we're talking about using this process of making an S1 registration statement with the SEC and having a cooling off period using the process we're going to be discussing to sell stock. All right, so A says, a primary distribution can only be made for equity issues. And once you get to a false statement, the entire statement becomes false. Let me get my annotation tool here going. And, one way you can proceed is you could put an F next to that saying, well, that is definitely false, right? Because you can use primary transactions for primary distributions for debt. In fact, in my lecture in corporate debt securities, I give you Ford Motor Company. Last year, they did an $8 billion primary distribution of bonds. They had an 8% coupon. Carnival Cruise Lines did a $10 billion debt deal. So that's false. By the way, you can stop once you get to that, and that's false. That means this whole statement becomes false. So be careful as a test taker. I don't care what comes next. So they're pretty good at, they make a kind of a U-turn and then they say, well, this part, you go, well, that part's true, but this part's false. That makes the entire answer false. All right, let's look at B. A primary distribution can only be made for issues that exceed a specified dollar amount, and that's not true, while a secondary conversion can be made for issues of all sizes. No, there's no size. It's not about size that determines what you're going to do. Now, I think what they're hoping there is maybe you fall for the maximum offer size, maybe in a Reg A, for example, but that's not true. By the way, even if you thought that was true, I would behoove you to read all the answers offered to you. Now, don't throw rocks at me, but I'm allowed to give you a right answer as a distractor. That's the technical name for a wrong answer. And so a lot of candidates say, well, gee, I got it down to a 50-50, and I thought they were both right. And I'm telling you they both could be right, and you're still going to get marked wrong if given two right answers, you don't come up with the most appropriate answer. That's particularly true of judgment questions. Anyway, C, a primary distribution must be made at a fixed public offering price. Well, that part's true. While a secondary distribution must be made at the current market price. That's not true. In fact, sometimes to get people involved, we'll give them a discount. Say, you're going to buy a large block of that stock? So that is not true. A primary distribution involves the sale of newly issued shares. That's true, by the issuer. And a secondary distribution, there we go. That was my Pritzker, Hyatt Hotel example, right? The Ford Motor Company went public in 1956, and none of the proceeds went to the Ford Motor Company. It was the Ford family generating liquidity to pay Henry Ford's estate tax. All right. Learn it once, get tested 3 times. So what I mean by this is this term registered securities or unregistered securities is really, really important. It's important on every exam. So, if you're going to take a SIE and then a 6 and then a 63 and then a 65, maybe 4 times. If you're taking an SIE, a Series 7, a Series 66, or a 763, again, it's testable. So you want to make sure you do that. So exemptions from SEC 33 registration and state registration, that's called the Uniform Securities Act. The Uniform Securities Act. And so, the SEC is God and state administrators think they are. So there's 50 demigods running around. And what we're saying is none of these securities I'm about to discuss with you need to be registered with the SEC under 33 or registered with the state administrator under the Uniform Securities Act. So when a Congress passed 33, they said your own government wouldn't rip you off. And so the U.S. government is an exempt issuer. They're allowed to issue brand new securities without making a registration statement. So the SEC or the state administrator says, Dean, were you selling securities in which you made no registration statement? Were you selling unregistered securities? I say yes, but it was a treasury bond. Neener, neener, neener. Don't suggest you say that part. but I don't need to register when selling in the primary market U.S. government securities or agencies of the federal government. That'd be Ginnie Mae, Fannie Mae, Freddie Mac. Remember, this is a twofer. Then what I mean by that is it's going to be not only on whatever exam you're taking, you're going to get at least two questions or two tests where you get tormented on this. The state administrator of the SEC says, Dean, were you selling brand new securities to the public without registering them? Were you selling unregistered securities? Did you sell securities that weren't registered with the SEC under 33 and were not registered with the state administrator in the Uniform Securities Act? I say yes, but it was a Clark County general obligation muni bond. You know, once Congress exempts themselves, the U.S. government, this concept called reciprocity or reciprocal immunity says that if the government doesn't have to comply, the U.S. government, states and its municipalities do not need to comply either. Now, be careful, ladies and gentlemen. For SIEs and 6s and 65s, that's the end of what you need to know about registering a municipal security. For you Series 7s, I highly recommend you check out my lecture on underwriting municipal securities, because the process is very similar, but it has some key testable distinctions only for Series 7 candidates. I know you're going to say, Dean, you're pretty easily impressed with yourself, and I am. That's a great lecture. I mean, I just love the way the flow of that lecture. I love what I've covered in that lecture. It's target rich. And when I revisit and circle back and start redoing these lectures, I probably will turn that from 2 lectures on munis to one giant one. But right now, there's a muni lecture that's appropriate for 6s and SIEs and 65s, and then there's by the way, that's in your playlist, and then there's one that's not. It's about underwriting munis. Scary but true. Scary but true. Is the imam at the mosque, our bishop at the temple, a rabbi at the synagogue, or pastor at the church? I say, ladies and gentlemen, what are you getting on your investments? That's ridiculously low. How about we do the Lord's work and we get a higher return? Today, I'm offering you church debentures. They pay 300 bips, 300 basis points, 3% over the junk bond index. You can do the Lord's work and you can get a higher return. Scary but true. That does not require a registration statement. Now, when they arrested this televangelist for making a fraudulent distribution of securities to the public, he said, I'm an exempt issuer of securities. And we said, well, you're a little confused about what that means. What that means is you don't have to make a registration statement. It doesn't mean that you can rip people off. Kind of a trick test question on all your exams. No one and nothing is exempt from anti-fraud provisions of either 33 or the Uniform Securities Act. So you can't say, aren't I clever? I used an exempt security to rip people off. No, you're still going to go to jail. Listen, this thing was written in the 1930s, and the USA, the Uniform Securities Act template, was written in the 50s. And so the language is quite different. Now, it's not that banks get a free pass. It's that banks have a different regulator. One of my favorite banks is Beal Bank, B-E-A-L Bank, owned 100% by Andy Beal. And if Andy Beal wanted to take Beal Bank public, he wouldn't be answering to the SEC. He'd be answering to the Federal Reserve Board, the Comptroller of Currency, and FDIC if he had a federal charter, or the State Banking Commission. So it's not when we pass this legislation, the banks got a free pass. It's that they already had a regulator on site, right? The SEC came after there was already a Federal Reserve Board, a Comptroller of Currency, and that. Now, again, common contract carriers. Don't you love that language? A common contract carrier is a transportation company that crosses state lines. Southwest Airlines is a common contract carrier. So if I'm a common contract carrier, again, it's not that I get a free pass. It's when we passed 33 and we came up with the Uniform Securities Act template, we already had regulators for these companies called the Interstate Commerce Commission. So it's not that they get a free pass, it's that they have a different regulator. I'll probably fix this slide. It says railroads, and that's what was intended in the 1933, but it's not only railroads now, because after that we have transportation companies like trucking companies and airlines and things like that. Commercial paper. I don't know of any exam in which you're not going to get asked about commercial paper. Now here we're just talking about whether it has to be registered. But I would remind you, it's very testable to know commercial paper is issued at a discount. It has a 270-day max maturity. It's large unsecured borrowing by corporations. And for our lecture today, is sold to money market fund managers who are capable of protecting their own assets, their own interest. Retail investors don't buy commercial paper. And so that's why they are exempt. Now be careful, RTFQ, read the full question. I didn't say a money market fund is exempt. I said money market securities being sold to money market funds are exempt. Again, this is not a lecture about money market securities, but by way of reminder, today's lecture is that bankers' acceptances do not need to be registered with the SEC or to the Uniform Securities Act because, again, they're being sold to money market fund managers who are capable of protecting their own interests, their own assets. Now, I would warn you, very testable to know that bankers' acceptances are used to facilitate foreign trade. They too are issued a discount, and they too have a 270-day max maturity. All right, so I like this one. So here's another one I pulled. Under the Securities Act of 33, a registration is required for which of the following securities? Now, what I would have done here is used process of elimination. Maybe you don't know what a Eurodollar bond is, but a Eurodollar bond is a bond issued in Europe that is denominated in US dollars. It's a huge, huge marketplace. So this is Nestle selling bonds that are denominated in US currency in London. Now, the SEC would like to run the world, but it does not. The SEC does not have regulatory authority outside the US. I always joke if, my assistant says, Dean, there's the SEC is on the line and FINRA's on the line. SEC line 1, FINRA line 2. I said, well, I better pick up line 1. The SEC is not a self-regulatory organization. And they say, Dean, do you know who we are? I say, yeah, you have primary jurisdiction, interpretation, and enforcement of the domestic keyword securities laws of the United States of America. So the SEC doesn't have regulatory authority outside the US. So nope. You should definitely know that munis are exempt. You should definitely know that that is an exempt transaction, or excuse me, exempt security. I got to be a little tighter with the language there. That munis do not need to comply with 33. And you should definitely know that I need not to comply, leaving us with ADRs. Remember, those are foreign securities that are held in a domestic ADR. An ADR is a domestic security, facilitates foreign trading. So kind of like that one. Should be able to get that one by process of elimination. Now, again, this is an exam on the primary market for corporate securities. That is a corporate security, but I would warn you that that is very testable as a product, right? As a product, you need to know that's used to facilitate U.S. citizens getting some asset allocation in foreign securities. And then you have foreign currency risk. Exempt transactions need not be registered with the SEC. So they say, Dean, did you sell brand new securities? The SEC. So now we're just talking about the SEC, so pay attention here. They say, Dean, did you sell brand new securities to the public without making a registration statement? I did. I say yes. They say, Dean, was it an exempt issuer? Was it the U.S. government? Was it an agency of the federal government? Was it a municipality? Was it a commercial paper? Was it bankers' acceptances? Was it a common contract carrier? I say, no, it was not. And then they say, well, Dean, what safe harbor did you avail yourself of? What safe harbor, what exemption did you use? If I don't come up with a safe harbor or exempt transaction I've used, I'm going to be in trouble. Safe harbor means we're not going to come after you if you do it this way. I said, well, I availed myself of Regulation A. Regulation A. I had a joke the other day, right? Reg A is not Bob Marley music. Now, I can't raise more than $50 million. Now, I'm making this lecture in, what is this? Late February 2021. And I would tell you that is going up to 75 million. And who knows when. So I don't know how long these lectures will live on the interweb, but, they'll be up there for a long time. So if you're testing, and you might want to check and see if this has gone through. My feeling is this won't show up on the test for at least a year, because first it really has to become operational in the real world. Then in the test world, the fantasy world, Series 7 fantasy, SIE fantasy world, 65 fantasy world 6, they have to take out the old questions, reintroduce the other ones, and it takes a while. Anyways, I was watching a thing. I couldn't believe it was Bobby Flay, and he was using a Reg A offering to raise $50 million for Bobby Flay's Burger Palaces. That was the issuer. And I kind of thought to myself, I can't believe he doesn't actually own, or no, excuse me, an investment banker who could, go get him some real money. I mean, comparatively speaking, right? Comparatively speaking. Anyways, this one's very testable. Rule 147, an intrastate offering of securities. So pay attention here. The SEC says, Dean, did you sell brand new securities to the public? I say, yes, I did. They say, Dean, was the issuer exempt? I say, no. They said, did you use Reg A? Was that the exempt transaction, the safe harbor you availed yourself of? I say no. They say, what'd you use? I say, I used Rule 147. I only offered the securities within the state. Within the state. I always tell, I'm sure in every lecture, you're probably going to hear the same story, maybe more than once. And if you're not clear, the stories have a point, a testable point. If not, put in the comment box, hey, Dean, was that just you rambling on, or was there some point there? But anyways, one of my favorite deals of my entire career was Del Taco Restaurant Properties. Del Taco Restaurant Properties was a Rule 147 deal. We would go raise $8 to $12 million to buy all cash real estate in California and build Del Tacos, fast food restaurants. Test question number one. For us to use the safe harbor, the issuer, Del Taco, has to have 80% of their business and assets within the state. That is testable. I have that come back on debrief quite a bit, that people encounter the 80% test. So they have to have 80% of their business and assets within the state. Now, be careful. The 100% requirement is that you have to be a resident of the state. So in the primary transaction for Del Taco Restaurant Properties, if you are not a resident of California, no Del Taco Restaurant Properties for you. Now, how do we determine residency? Residency is not determined by physical addresses. There are all kinds of people who have physical addresses in California that aren't residents. Your residency is determined by where you vote, where you pay taxes. If you vote in the state of California, you pay taxes in the state of California, you are a Californian. Please note, I'm not a Californian anymore. I retired out here to Las Vegas, so I don't pay taxes in California, and I don't vote in California. Now, after 6 months, the persons who actually bought the Del Taco Restaurant Properties can sell that to somebody else who's not a resident. Please note, I suggest you do the same with yourself. Give yourself some perspective. So if you're listening to this lecture and you're a resident of Illinois, use Illinois. Say, okay, I can only sell this within Illinois. I can only sell it to Illinois residents, and the issuer has to have 80%. Now, be careful on this one. This is a lecture where I try and put as much performance opportunities, target richness, if you will, into these lectures as possible. And I, can do that because, again, I'm not following any kind of a, roadmap about how to get from point A to point B. But I told you, this is going to be in every playlist. And one of the things you're going to get asked about in the Uniform Securities Act is a safe harbor that does or does not apply to the state. So my Del Taco Restaurant Properties is exempt under 33, but it's not exempt under the Uniform Securities Act. It's not exempt under the Uniform Securities Act. And so what it means by that is I'm still going to have to register this security with the state. And the way I'm going to do that is through qualifications. I'm going to ask the state administrator of California, what do I need to be able to do to qualify Del Taco Restaurant Properties to sell to residents of your state? And whatever they say, I say aye. So test question, not on your SIE, not on your Series 7, but on your Uniform Securities Act test, that's either going to be 63, 65, or 66. Make sure you know that Rule 147 is exempt under 33, but not exempt under the Uniform Securities Act. All right, so again, we're talking about safe harbors, exempt transactions. The way I'm selling it, that means I don't have to register it with the SEC. And so here's our third one. Rule 144A. I'm going to get a text box here because this is one I want to actually add a text to. It's worth the additional text box. 144A says that quibs, let's see what font size I got here. 36, I think is fine. Quibs can buy I'm going to say buy, but it could be buy or sell. I mean, trade, but they can buy unregistered foreign and domestic securities. And so they say, well, Dean, did you sell a brand new security or secondary? Did you sell an unregistered, restricted security? Restricted means restricted in terms of transfer. I say I did. And they said, but Dean, you didn't register. I said, well, no, but I used 144A. I only sold it to qualified institutional buyers of securities, which leads us to our second test question. What is a qualified institutional buyer of securities? That is somebody who has at least 100 million in AUM, assets under management. For example, Fidelity is a qualified institutional buyer of securities. T. Rowe Price is a qualified institutional buyer of securities. They manage over $100 million, way over, but 100. And they own about each of them 6% of SpaceX. SpaceX is not a public company. So the stock they own is unregistered. And again, T. Rowe Price and Fidelity are allowed to own unregistered foreign and domestic securities. Now, pipes can be here or pipes can be in Reg D, but pipes show up on the test, and a pipe is, let me get my thing here, is a private investment in a public entity. So there's our P, there's our I, there's our P, there's our E. Here, what we're going to do is in a public entity, it's already publicly traded. For example, Tesla has said that they're going to issue, besides selling a bunch of electrical cars, they're going to sell $5 billion worth of Tesla stock each year for the next 3-4 years for working capital. And so if they want to sell that $5 billion in unregistered stock that's authorized, but, hasn't been registered, they could do it through a pipe. They could call T. Rowe Price and say, hey, you want to buy, 10 million shares of Tesla as a pipe, a public investment, and a private investment in a public entity. Now, the shares they would be receiving in the pipe would be unregistered, right? They'd have to hold them 6 months, and it could be Reg D as well. I just bring it up here because it shows up more often. It wouldn't be a pipe in my SpaceX example because that isn't a public entity. So this would be a private investment in a public entity, and a lot of times QIBs do that as well. I could also do that transaction using a Reg D, which is coming up here in a moment. Reg D private placements. I would definitely have a handle on this one. This is an exempt from registration, other safe harbor. And this is an investment made by invitation only. So they say, Dean, did you sell brand new securities to the public? I say, I did not. I did not sell brand new securities to the public. I sold the securities, but it was by invitation to the invitation only, and it wasn't to retail investors. Now, the document we're going to use here is a private placement memorandum. A private placement memorandum. Now, by the way, test significance, learn it once, get tested twice. This one is exempt from both. What I mean both is I don't have to register this under 33, and I don't have to register it under the Uniform Securities Act either. So that's one of the few that is exempt from registration under 33 and exempt from registration under the Uniform Securities Act. Now, 506B and 506C, I don't think is a testable distinction, but 506C, I can't advertise, and I can have up to 35 non-accredited investors. Now, that doesn't mean that I can have, 35 Joe six-packs, sophisticated. 501C, I can advertise, but I can't have anybody who's non-accredited. So kind of a trick. In a private placement, you can have 506B is the more testable version, but in a 506B private placement, I can have an unlimited number of investors, but no more than 35 who are non-accredited. So be careful. You can have, take those spots are a little more, premium, so to speak. All right, very testable. What is an accredited investor under Reg D? A accredited investor under Reg D is $200,000 in annual income for the last 2 years, with the expectation of $200,000 this year. Now, the assumption here is if you're making 200 grand a year and you make a losing investment, who cares? Work another year. Nobody really cares about you. That's not what these rules are designed to protect, is people like yourself, right? You're married and filing jointly. So I want you in my private placement. I say, do you make $200,000 for the last 2 years with the expectation of $200,000 this year? You say no. I go, hold on, I got another one. Are you married and filing jointly? Do you make 300 grand for the last 2 years with the expectation of 300 grand this year? You say no. I go, oh man, damn. Hold on, I got another one. I want you in my deal. By the way, again, the assumption here is if you are making 300 grand a year and you make a bad investment, so what? Work another year. The assumption is if you're not sophisticated, you can rent somebody who is to look after your own asset, your assets, your interest. I said, do you have a net worth of $1 million exclusive of your primary residence? Exclusive of your primary residence. You say no. I said, well, good news for you. I am using a 506B, and so I can have up to 35 non-accredited investors. Now, it's important that the person know that when they accept this, that they're buying unregistered securities, restricted securities, right? This may or may not be the idea, but at some point, maybe we decide to go public. Beyonce was in on the private placement for Uber. So before Uber was public, she participated. So, we have to ask Beyonce, do you make 200 grand for the last 2 years with the expectation of 200 grand this year? I think the answer is yes, but let's assume it's not. Do you and Jay-Z file jointly? Do you make 300 grand for the last 2 years? I would assume she'd say yes. But if she says no, I say, hold on. You have a primary residence, exclusively primary $1 million net worth. She says no. I said, I'm going to let you in Beyonce with one like 35 spots. I'm joking. Now Uber's gone public, right? But she needs to understand, any client needs to understand that you're buying unregistered restricted stock. So the idea is now Uber goes public and she has these unregistered shares in Uber. And, what does she have to do to sell them? She has to hold them 6 months and, different discussion than we're having right now. But, well. I like this one. So there's one I pulled. Again, these questions are appropriate for everybody. Under Rule 144A, so remember what that's about? That's about a qualified institutional buyer of securities. And we said as a qualified institutional buyer of securities, you're allowed to buy unregistered domestic and foreign securities. Now, unregistered restricted are intellectually synonymous. Restricted means restricted transfer. You just can't transfer this to anybody, right? These stocks can only be transferred to, other QIBs. And so it's not a financial institution, no. It's not an accredited investor, it's a QIB. It's a QIB. Remember that? I would definitely know they have to have at least 100 million AUM, assets under management. There's another one I pulled. A married couple who earned income that exceeded. I got to clean up that slide. I'll do it after the lecture. That exceeded 300,000 each of the prior 2 years, and reasonably expect same for this year is. Boom. You should definitely know that. Remember, it could be a single person, 200, and then $1 million exclusive of primary residence. Types of underwriting commitments. My firm was called Gamma Global Investments. And on the banking side, the only kind of deals that Gamma Global did was best efforts. I said, I'm going to do my damnedest to raise this money for you, my firm. But at the end of the day, I'm not willing to buy these securities or put my broker dealer's net capital at risk. So a best efforts deal, I'm saying I'm going to do my damnedest to raise the money for you, but, I'm not willing to risk my own. Gamma Global Investments was hired by the issuer to raise $3 million to build a brasserie for this celebrity chef. So it's going to be a Reg D private placement. So what I'm hunting for are accredited investors who might want to invest. And we need $3 million to open the brasserie. So I'm going to establish an escrow account. As I raise the money, I'm going to tell people, unless we get $3 million in that escrow account, we're not going to break escrow. P.S., I had $2.7 million in this escrow account. And this guy, Gary, I was giving him a tour of the big empty space where the brasserie maybe exists someday. Anyways, we're walking through the space and he says, Dean, I like the scale of this place. I said, well, geez, Gary, if you like the scale of this place, you're my kind of guy, because a lot of people get wobbly. They come in and see a big empty box like this with a hefty monthly lease payment. But he says, what do you need to get this thing going? I said, well, we're at 2.7. And if I had another 300 grand, I could break the escrow account. He said, well, I'm in for 300 grand. I'm not misrepresenting this. I really, literally feel like kissing him, because remember, 300 grand, if he puts 300 grand in, now we are at our escrow thing and we can break escrow and start building the brasserie. So by the way, if we've not got the $3 million, then we have to give everybody back their money and say, never mind. Now, it's also important for Gary to understand that Gamma Global Investments, my broker dealer, is an underwriter, is an agent to the issuer. So I don't represent him as I'm taking him through the due diligence tour of the would-be brasserie. I represent the issuer. So it's unlikely that if he asked me, Dean, do you think I should invest $300,000 in this brasserie? I certainly do. But I say, Gary, I certainly do, but I have to disclose to you that, I'm an agent to the issuer. I'm not your agent. So it's unlikely I'm going to say not to invest, right? So it's very important, whether it's in banking, which we're talking about now, or in secondary transactions that we disclose in what capacity the broker dealer is acting. Is it acting in its broker agency capacity, or is it acting in its dealer principal capacity? That's important. Firm commitment underwriting. As I said, Gamma Global, we never did firm commitment underwritings, but Morgan Stanley certainly does. And a lot of people don't remember that the Facebook IPO was a wobbly deal. It wasn't a hot issue; it was a sticky issue. Morgan Stanley was the lead underwriter, and they told Mark Zuckerberg that they were going to get him $38 a share on a firm commitment basis. On a firm commitment basis. They're willing to risk their capital. Anyways, when that thing was wobbly there on the IPO day, people said, "What Zuckerberg doesn't look like he's concerned." I said, "Well, why would he be concerned? He's got no risk. I mean, as far as he's concerned, the issuer is concerned, Facebook, this stock is sold at 38. Morgan Stanley said, "Hey, Mark, it's, a little wobbly here. And, it looks like we're going to have to stabilize the issue." And, and he said, "Sounds like a personal problem. See, you wouldn't want to be you. The way I understand a firm commitment underwriting, that's your stock in Facebook at 38. And what you do with it is your problem." How is his understanding of a firm commitment underwriting? It is very good. So in a firm commitment underwriting, you're not buying the stock from Facebook. You're buying the stock from the syndicate, in this case, led by Morgan Stanley. So in a firm commitment, the underwriter is acting in its dealer capacity. Remember in the previous one, I'm an agent to the issuer. Here, I'm not an agent to the issuer. That is my Facebook stock. P.S. Whatever we don't sell is going to go into inventory. We're going to say, "Attention brokers, blue light special." The syndicate is a risk and liable for unsold securities. That's very important to understand that. Now, we're going to build our bracket. That's kind of where we're heading. And so, Schwab has lots of customers who might want to participate in the IPO for Facebook. And so Morgan Stanley would call Schwab and say, "Hey, would you like to join Morgan Stanley's selling group?" Now, if you're in a selling group, it doesn't matter what kind of syndicate you're joining. Selling group members, let me get out I guess I try not to get, lazy in these lectures by not, getting out my highlighter, and telling you, what it is that you need to know. That's definitely testable. So TQ means test question. Now, remember, that doesn't mean verbatim a test question. It just means you can expect content around that. Sometimes I'm pretty close. I mean, I don't know about you. When I take a test, I like to get to the first question I know the right answer to. I go, all right, it's something I know. All right, I want to walk you through an example of a firm commitment underwriting. Again, the language is a little different. The language is a little different on your municipal underwriting, so I would warn you, Series 7s. For the rest of you, this lecture is fine. So if you're any other candidate than Series 7, this lecture is all you need for primary market on your exam. If you're a Series 7, I want to highly recommend to you that you also need to go check out the version I did for munis under underwriting municipals, because the language is a little different, the test questions are a little different, and I want to make sure you do that. I decided to carve it up into 2 lectures, hoping I would make this lecture a little more manageable than having to go back and forth between, corporate versus muni. So anyways, on the front page of every prospectus, we're going to show you this. We're going to show you what the public offering price is, and we're going to show you the gross that we're raising. And then we're going to show you net per share to the issuer and net what we're raising. So here, a syndicate has told a corporation or has a firm commitment with the issuer to sell 10 million shares at $9.20 net. Now, that means the issuer is done. The issuer knows that even if we don't raise this money, we're still going to give them $92 million, right? So as far as the issuer is concerned, this deal is done. Not a test term, but in the business, we call that a bought deal. BOT. Just say the issuer. Gamma Glow, I might lose a deal because they say, "Hey, Dean, I got another guy who just tell me he'll do it, and he'll be at risk, and I can't do that." I say, "I got to go out and find the money, right? I got to go out and find the money." Anyways, I'm going to show you this, what's happening. So some of this money is getting stuck in the middle, right? Not all the money that's going here goes over there. It gets stuck. Some of this gets stuck in the middle. Now, we're not going to show you on the front page of the prospectus how we're going to split that up, because that would just cloud your mind. But there's 80 cents to be made on every share sold. And then what we're going to get tested on is how we're going to split up the spread. This is the total spread here. The total spread, let me get my thing out here, very testable, is the difference between what the issuer receives and the public pays is known as, that'd be a test question. And I'm going to show you how we're going to carve this up here in just a sec. How we're going to split this money. Now, the other very important disclosure that's on the front page, so we're going to show this to you on the front page of every prospectus. And the other very important disclosure we're going to make on the front page of the prospectus is the SEC neither approves nor disapproves of any securities offering. They neither pass upon the adequacy or the accuracy of the information contained herein. Any claim to the contrary, by the way, we don't care about that first part. The last sentence is what we care about. Any claim to the contrary is a criminal offense. A criminal offense. Wow, go to jail. There's not many things you go to jail for as a broker. I mean, if you meet a broker in jail, it's usually for violating 33, making a fraudulent distribution of securities to the public. Jordan Belfort had a firm called Stratton Oakmont, and he went to jail, went to Taft Federal Prison outside of Bakersfield for making a fraudulent distribution of securities to the public. His cellmate when he was there, Club Fed, Taft doesn't even have a fence around the place, but his cellmate was a guy named Tommy Chong of Cheech and Chong. And they started telling stories, and Tommy Chong said, you ought to write a memoir, man. Your stories are even better than mine. He says, why not? I got nothing but time on my hands. And so he wrote his memoir called Wolf of Wall Street. Then he sold the screenplay for $10 million. Now, by the way, if you're one of the investors that he ripped off, you're kind of upset that he's, receiving $10 million for the screenplay, and you're watching Leonardo on the screen, playing Jordan Belfort. Come to find out, Wolf of Wall Street was made with dirty money. And, Jordan Belfort said games recognize his game, and Red Rock Pictures, when they asked him to get involved in promoting the movie, he said, no, I'm on probation, and, I could get in trouble. The 3 stages of money laundering test question are layering, integration. That's not this lecture, but if I can throw in a free point for you. Whoop. Placement is first stage, placement. Layering and integration. So boy, and Hollywood's a great place to place your dirty money, right? If you're Red Rock Pictures, which was set up to, launder money out of Malaysia, 300 million, 200 million. And then we're going to mix the clean money from selling movie tickets and paying Leonardo and Scorsese and, doing the movie. We're going to mix the dirty money with the clean money. And then we've arrived at our thing called integration, where you can't tell the dirty money from the clean money. If you saw Breaking Bad, Vince Gill is the showrunner, and he's got it written down. His wife on Breaking Bad is in charge of money laundering, how to, and she's got a car wash, right? That's a great one, right? I can say I watched, 50 cars a day at $20 a car, and Ozark is popular. Now, remember, we're not money laundering how to, we're anti-money laundering, right? So we have to have written supervisory procedures about how we prevent, money laundering. This guy got caught, and I thought he was silly. He could have used our help, but anyways, missed the first stage. He was skimming the Port Authority's parking meters, and he got caught because the bank filed a suspicious activity report. And he didn't have any explanation for the quarters. Now, if he would have bought a vending machine company, maybe he had an explanation for that. All right, so let's talk about how we split up this 80 cents. So we said we're going to make, when it's all said and done, 800 grand, and let's talk about how we're going to split up this money. So here is the spread that we're working on. As we said, we're not going to, tell the public this is none of their business. But, if I'm the manager, let's say Bank of America Merrill Lynch is the manager. And Bank of America Merrill Lynch has the exclusive contract with the issuer. You can't get the stock without coming through Merrill Lynch. And so, as we said, test question number 1 is, what do we call the difference between what the issuer receives and the public pays? That's called the spread. And the spread here is 80 cents. As I mentioned to you, in a bond, it would be different. So make sure you check. If you're 7, you don't need to worry about if you're not a 7. Municipal components. So the minimum that Bank of America is going to make on every share sold is 10 cents. So regardless of who sells the shares, Bank of America is getting 10 cents. And test question, That is typically the smallest individual component of the spread. That's a test question. They say, what is typically the smallest individual component of the spread? You would say the management fee. Now, if you're a member of the syndicate, if you were one of the syndicate members, a member of the underwriting syndicate, you're going to be able to take down the stock from Merrill at $9.30. And then you got to decide whether you want to build your own bracket or sell it yourself. If you want to sell it yourself, you would make this entire 70 cents here. But if you want, you can sign up people under you. You can call up Schwab or Fidelity and say, would you like to join my selling group? Now, ultimately, selling group members are not members of the syndicate, and they're not liable for unsold securities. And so if all you received here was this 50 cents, the selling concession, test question, the selling concession is typically the largest individual component of the spread, the largest individual component of the spread. And so if I say on your exam, what is typically the largest individual component of the spread, you would say the selling concession. That's a test question. Now, if you only receive 50 cents, if I show you this as an exhibit, exhibit questions mean I'm going to show you something like this and ask you about it. And in this example, if all you made is 50 cents, you're a member of the selling group. So let's set this back up here. Here's our example of our spread. I show you this exhibit. I said your firm made 10 cents on a share that some other broker or dealer sold. Your firm made 10 cents on a share that some other firm sold. Who was your firm? Was your firm A, managing underwriter, B, member of the syndicate or syndicate member or underwriting member? I mean, that's a lot of ways to say that. And you'd say, well, that would be the manager. That would be A. They say on your exam, your firm made 50 cents and was not at risk for unsold securities. Your firm made 50 cents and was not at risk for unsold securities. And you would say, member of the selling group. Now, regardless of whether it's divided or undivided syndicate, that's where we're heading, doesn't matter. You're not at risk for unsold securities because you're not a member of the syndicate. Little trick here. Your firm made 20 cents on a share that some other firm sold and was at risk for unsold securities. Right? That's the ones you're building your bracket and you're building your selling group that you're going to give to your selling group. So, if I'm a member of the, not the manager, but I'm a member of the syndicate and I'm getting the stock at 9:30 and I call, Edward D. Jones and say, hey, you want to join my syndicate, join my bracket? They say, yeah, what can I have the stock for? I said, I'll let you have it for 9.50. And they said, wow, you're getting it for 9.30. I said, well, I am because I'm a member of the syndicate and you're not. The only ones who can get the stock for 9.30 are members of the syndicate. And that would be syndicate member. If I say made 70 cents, that would be the same answer, right? Now, if I say you made 80 cents, the only firm that can capture that component, the entire spread, is the managing underwriter. Because, if Merrill, in my example, sells this, they're going to get all of this. All right, so let's give you an example of this. This answer set is just important. So, I want to make sure you understand this answer set. If I say, which of the following is not at risk for unsold securities, the answer is A. If I say, who receives the smallest individual component of the spread, the answer is C. So just make sure you're comfortable with this language. All right, so we're doing 10 million shares, and there's two types of syndicates. Now, Western and Eastern are associated with municipal syndicates, but intellectually, it's the same deal, right? So again, beyond, if you're not a Series 7, you don't need to worry about munis, but in terms of underwriting, if you're 7, you better check out that lecture sometime between now and test time. But anyways, here we're doing a $10 million share deal. And I say to you as a syndicate member, I'll play manager. I'm Bank of America, Merrill Lynch, BAML. I say, how much do you want to take down? You say, Dean, I'll take down 3 million. So in a divided syndicate, what goes down stays down. So if you tell me you're going to do 3 million shares, you're going to do 3 million shares. You are individually responsible. For selling these stock, right? So, if I call you and I say, how you looking on your 3 million shares? You say, well, Dean, I said, whoa, you got a mouse in your pocket? There's no we. You said you'd do 3 million, you're doing 3 million. They said, well, we're only able to do 2.5. What happens to the other 500,000 shares? Do they go to share heaven? Are they up there with the puppies? I said, well, no, they go into inventory and you say, attention, blue light special brokers, right? They go into inventory. Undivided, it's not important that this is 3 million shares. It's important that this is 30% of the deal, right? 3 million of the 10 is 30% of the deal. In an undivided syndicate, we're responsible based on our percentage participation. You know, I think of Western, I think of John Wayne, Clint Eastwood, mano a mano. You tell me you're going to do something, you're going to do something. You know, Eastern, I think of Harvard, Yale, Princeton, you know, mafia, they're always in it together. You know, but here I call you and I say, listen, how you doing on your 2 million or 3 million shares? You said, well, Dean, I've only done 2. I said, ooh, you're not going to be popular. I've checked in with all the other syndicate members. They've done yours. So I'm going to reallocate, you know, the shares to the other syndicate members based on their percentage. So I bring back up the million because you only did 2. I'm going to leave you with 300,000. That's of the million to chew on. Now, ultimately, as a manager, I'll decide when to break syndicate. You know, I call you and I say, hey, Dean, I say, Dean here, BAMO manager, checking in with people. How you doing on your 3 million shares? You go, Dean, we did our 3 million. We're done. I said, well, if we're only true, if this were a Western divided syndicate, you would be done. If you said you'd do 3 million shares, you did 3 million shares, you'd be done. But this is not a divided Western syndicate. This is an Eastern undivided syndicate. And that's why I've called you, because I'm doing reallocation. You say, oh, that means I have some shares for you. Right? You say, well, how many shares are for me? I said, well, let's see how you did on your series, whatever. By the way, this is way more series 7 oriented. This particular slide, you know, not the discussion, this particular slide, than, you know, it is for SIE. You don't need to worry about this slide. 65 doesn't need to worry about this. I told you I'm putting it in all the decks. 6s don't need to worry about this. This is a slide just for 7s. Maybe I'll start, you know, labeling the slides as such. But anyways, back to the discussion. I have 1 million shares, and so 300,000 belong to you. P.S. in the real world, you're not going to be very popular if you're not getting it done. We may not invite you back. I did did a class for Artemis Capital. How cool is this? These are lady investment bankers in public finance, really classy ladies. And, you know, they said, Dean, the way I think of it is a family dinner. In a Western family dinner, all you got to do is eat your own meal. But once you eat your own meal, you have to leave the table. In an Eastern family dinner, we keep dividing it up and nobody leaves the table until it's all done. All right, so here's an example of a syndicate we've been discussing. So as we see here, we have our managing underwriter who has the exclusive contract and get the stock at 920. And as a syndicate member, here's UBS. UBS says we're going to take down 3 million shares. And as we said, they're going to pay 930. So there, oops, excuse me, that should be 950. That should be 950. And that should be 950. I'll fix that when I get done with the lecture here. So remember, Merrill makes 10 cents. Oh, no, not my bad. I didn't have the slide correct. So I say how much you want to take down on every share sold. It doesn't matter who sells it. Bank of America, Merrill Lynch, BAML is making 10 cents on every share sold. Now, here you can see Morgan Stanley did not decide to build a selling group. They didn't build their own bracket. And so Morgan Stanley is going to sell that to its own customers at $10. And they're going to make 2 components of the spread. Here, as you see, UBS has decided to build its own bracket and sign up a selling group member. Now, remember, Fidelity is not a member of the syndicate. It's a member of UBS's selling group. And so UBS says you can have some of our shares at 950. And please note, that means UBS is making 20 cents there on those shares. And then Fidelity is going to sell that to its customers. Let me get a different color here. At $10, and Fidelity would make 50 cents. Or the largest component of that, that's called the selling concession. Let me just put that in there. I'm going to put it tiny because, you know, it's. And then remember, they're not going to be at risk for unsold securities. So, you know, if this thing blows up, it doesn't matter to Fidelity. I'm going to get that concession. And as you can see here, our friends at our member of the syndicate here. JP Morgan is going to build its selling group. And there we go again. I'm just showing you how this kind of works. Now, remember, BAML's going to sell some of the stock to its own customers, right? Bank of America Merrill Lynch has its own huge distribution network. And so it's going to sell some of the stock directly to its customers. And in that case, you can see here, they would make the entire spread, right? We said the only person who can capture the entire spread is the manager, right? That's the only one that can actually capture the entire 80 cents. And then remember, BAML is going to build its own bracket, perhaps, and maybe it signs up Edward D. Jones, and remember, it's going to make the 10 cents here. So, they might build their own group as well. It's not contestable. That's called building your bracket. As you can see, kind of looks like multi-level marketing, not coincidentally. Anyways, we're offering 10 million shares here to the public. And, my broker says, I want some. Very testable in terms of IPO allocation practices. As an associated person, when you get past your exams, people say, oh, I'm so glad you're in the business and you can get me, some stock. And I say, no, unfortunately, associated persons, let me get a bigger, this one, I need a bigger font. Associated persons, and we sure don't want that in yellow. Let's put that in red. Associated persons and their immediate family members are prohibited. They're not allowed to have the stock. I mean, if we didn't have this rule, you'd never see the good stuff because we'd keep it for ourselves, right? BMW came out with this car. It was beautiful, called a Z8. This thing is so gorgeous. Anyways, in the Bay Area, I saw like 8 of the Z8s and 5 of them had dealer plates. The BMW dealers were failing to make a bona fide distribution of that car. Now, for our business, we tell that BMW dealer he has to put that on the lot and he has to sell it at the manufacturer's suggested retail price. Obviously, the car business is not like ours. And we tell him you can't sell the Z8 to an employee of the dealership or an immediate family member of the dealership. By the way, you can't sell it to fiduciaries, finders and fiduciaries. That's people, attorneys, accountants to the underwriter. You can't sell it to portfolio managers. IPO allocation. What we're worried about is with a portfolio manager of a mutual fund, you might call and say, hey, why don't you open a personal account with me? I'll throw some IPOs, some hot issues your way, some instant profit opportunities. We have a little community. It's going pretty good. It's on subreddit. It's called R Series 7. And as a joke, I said, what does IPO stand for? And we had great fun the other day. Everybody coming out. I was joking. It stands for instant profit opportunity, or it's probably overpriced. But anyways, I'm not supposed to do this portfolio manager because I say, listen, you do for mama, mama does for you. So if I throw some hot IPOs your way, I expect you to give me some trading business from the fund. That's definitely prohibited. It's called the anti-reciprocal rule. We're not supposed to have demand quid pro quos to do business. That fund manager is supposed to be doing business with whoever he thinks can get the fund the best execution. All right. I like this one. Let's go back. As you can see here on the top of that, managing underwriter, the manager, that's where the syndicate desk resides at BAML to know, how many shares are going where, right? So as we said, we said that UBS in our example, I think we said is drawing down 3 million shares or taking down 3 million shares. Let me change my color here. And so somebody's got to keep track, of where all the stock is going. 3 million there, maybe this is 2 million here, maybe it's 1 million here. And so we got to have somebody who's going to keep track of that stock. And that's what the syndicate does is they keep track of that. So determine the list of the selling shareholders. Nope. Yep, that's what they do. Build an order book and allocate the stock. That's exactly what they do. All right, so we've made the registration statement that we're going to sell brand new securities to the public. This is called an S1. We've told the SEC that we plan on selling brand new securities to the public. Now, once we make that filing, we enter into what's called the cooling off period, which is a minimum of 20 days. That is very testable. The way I think of it is, that's what we do to young lovers. We park one on the East Coast, one on the West Coast, tell them to cool off. If they still feel the same way, go for it. We didn't have the cooling off period. I'd be calling you every day going, psst, this thing is going to be hot. You know what IPO stands for, don't you? Instant profit opportunity. Now, what I'm supposed to do if you call and ask is say, I'm sorry, we're in the cooling off period of quiet time. I'm not allowed to comment on the prospects of the issuer. What I can do during the cooling off period, which test question is a minimum of 20 days, is I can send you a red herring, also known as a preliminary prospectus. That is very testable. It has pretty much everything you need to know to make a decision, except test question, no public offering price. That's pretty important. I mean, you need to know the price, right? Now, based on that test question, I can accept indications of interest, which very testable are non-binding on all parties. Very testable. The indications of interest are non-binding on all parties. Not testable for your own edification. I know whether the thing's going to be hot or sticky based on my indications of interest. In our example, we're selling 10 million shares. And so if I got indications of interest for 15 million shares, I'm going to jack up the price. Typically there's a window. In our example, we're offering 10 million shares. If I only got indications of interest for 7 million, it's going to be sticky and I'll lower the price. Not testable. That's kind of that. Now, what we're supposed to make sure we don't do, very testable, is no omissions of a material fact. A material fact is the kind of fact that had you known it, you might not have invested. This broker is being interviewed on the front page of the Wall Street Journal, and they asked him why he didn't tell the person this information. And he said, I thought I'd lose the sale. I can't think of a worse answer than that. That means you knew it was material, non-public information. I'm supposed to say, this may cause you to change your mind, but something you ought to know. Now, what this means is if it's all information is truthful and relevant, it better not be false and misleading. Blue sky is very testable. There's always a sign when you leave one state and go into another that tells you leaving California, welcome to Nevada, or leaving Nevada, welcome to Utah, because there's a lot of things that change. Talk about, gun laws or liquor laws. Utah has some real funky liquor laws. Here when I moved to Nevada, I saw a guy with a firearm and I said, gee, thank you for your service. He goes, what do you mean? I said, well, you're a police officer, right? He goes, no, this is an open carry state. I said, oh, I used to work there, just regular people walking around with firearms, but oh well. So now the way we're going to do this test question, learn it once, get tested thrice, is just because I'm okay with the feds doesn't mean I'm okay with the state administrator. So if I want to sell this initial public offering in the state, I need to test question, coordinate with the state administrator. At the same time I'm going through this process under 33, under the Uniform Securities Act test question, I'm going to coordinate. So remember we said we have two we've talked about in this lecture thus far. We said qualification. My Del Taco restaurant properties, I can't do coordination because I'm not doing an S1. I'm not registering with the SEC. And we said there I'm going to do qualification. Here, test question, I'm going to do coordination. And then I would know this term blue sky refers to state securities laws. It refers to the Uniform Securities Act. By the way, not only that, but for our purposes, that it refers to laws that are unique to states, and securities laws are different. So in your Uniform Securities Act, that's a template. That's not your actual state's, laws. I highly recommend. I read the memoir of Ricketts. Tom Ricketts is the founder of TD Ameritrade. And he said he took his exams when there wasn't a Uniform Securities Act template. There was, but each state tested differently on it. And he had to fly around the country taking different versions of the test. And I joke, I want to send him a letter saying, can you tell me what date that was? That'd be an interesting tidbit for us. So good news for you. You just passed a test that the North American Securities Administrator Associations have collectively agreed to, and you'll be good. But you are going to get tested on that coordination. All right. So now, assuming we make it through the process, which we said is a minimum of 20 days, embarrassing. We had recently an issue where they never made it out. They went into this thing and they never made it out the other end, called WeWork. But assuming you make it through, now it'll be trading in the secondary market, right? So now it's trading in the secondary market. It's going to be trading on either NASDAQ or New York, depending on which market center they chose to put their stock on. And so maybe you missed the IPO allocation. Maybe you missed the IPO allocation. You say, hey, Dean, I missed the IPO allocation. No surprise, right? I mean, a lot of times there's not going to be a stock for you. But anyways, you missed it. You say, Dean, I'm going to go ahead and step into the secondary market and buy it on the New York or NASDAQ, depending on which market center. I say, yeah, that was certainly cool. We can do that. And you say, Dean, do it in my margin account. I say, no, can do. Test question. You can't buy an IPO on margin. It's considered an IPO 30 days from the effective date. I would definitely know that. So, we're talking about 33 here, but 34 gave the power of credit extension to broker dealers to customers to the Federal Reserve Board. And Federal Reserve Board says broker dealers can't lend money on IPOs. Prior to 33 and 34, the New Deal, we as brokers were in charge of that. And when we were in charge, you give me 10%, I'd loan you 90%. You give me 10 grand, I'd loan you 90 grand to purchase all securities, including new issues. That was called the Roaring 20s. Every had great fun, but at the end of the Roaring 20s, there was a crash. And we decided perhaps that broker dealers aren't the best decision makers about credit extension to customers. Better to have it on the shelf and not need it than need it and not have it. So as your investment banker, I say, listen, when we do this S1 registration, why don't we go ahead and tell the SEC that we're going to come back within 2 years and do a follow-on offering? Go ahead and register it. And that way, all we have to do is amend the existing registration statement that we have on the shelf, and we're good to go. It's easier to amend one than to start all over. If we don't do the shelf registration, then we got to start all over again with this whole process. And that's kind of a pain. So on a shelf registration, the issuer registers authorized but unissued shares. We say that within 2 years, we might want to come back. For example, Google went public at 85 and then did a follow-on APO, an additional public offering, a follow-on 2 years later at 150, got some more money. And they don't need to file a new registration statement. As I mentioned, they just amend it. Now, if you're a well-known seasoned issuer of securities, which is going to be hard for an IPO scenario because a WIXI not testable has to have $700 million in equity outstanding or $1 billion in debt. Who cares? Not testable. But very few IPO issuers are going to meet this definition of WIXI. So their version is going to be 2. But if it's a WIXI well-known, their shelf is good for 3 years. Disney, for example, is a WIXI. At Disney, when they bought Fox, used their shelf registration to pay for it. They had securities that were registered with the SEC. They were authorized, but they had not been issued, and they were issued to the Fox shareholders to make that acquisition. Not testable, but the 2 years, you still have to get permission from the SEC. I shouldn't say permission. You let them know and they can stop it. Like Hertz was going to use the shelf to sell securities. They're not immediately effective because they're not a WIXI. And the SEC said, let's get this right. You're going to use the shelf to sell equity in a bankrupt company? As well, maybe not. But 3 years they're immediately effective. What I'm saying is Disney doesn't need to have permission from the SEC to issue the stock with the shelf. It also gives us flexibility. It doesn't have to be an acquisition, but it gives us better timing, right? If the getting's good, let's go out and get some more money, right? A broker dealer is permitted to accept payment for a new issue from the customer when the registration is effective. I like that a lot, but let's see if there's anything better. When the red herring is delivered, absolutely not. You're supposed to know that anything you get during this period is the cooling off period is non-binding. It's very untestable to know that that is a non-binding. I saw one guy, he had his cooling off period extended. He started out okay. He started out by saying, people were asking me, he goes, I was reading the Sunday New York Times, by the way. I couldn't even believe he's giving an interview because he's in the cooling off period of quiet time. He says, my bankers and attorneys tell me I'm in this thing called the cooling off period quiet time. I'm not supposed to comment on the prospects of my issue. But he says, let me tell you something. When I get this money, man, I'm the first one to the cloud. Watch out, world. The SEC says, we think you were hyping your deal. And so I'm going to extend your cooling off period. But anyways, back to this question. No, you can't be doing anything. What you accept are indications of interest, very testable, which are non-binding IOIs. Red herring, Plymouth, nope. Boy, these are big time no-nos. Now, so I guess what I would say is you can do 3 things, right? You can get the red herring out to them. You can accept indications of interest. You're not allowed to advertise a new issue, but you are allowed to place a tombstone. If you're in a graveyard and you see a tombstone, there's not a lot of information on that. It says loving father, husband, for more complete information to see the obituary. A tombstone would say, this is neither an offer to sell nor a solicitation to buy the following securities. An offering is made only by a copy of the prospectus. Read it carefully. Do not send money. I put an A, B, C, D here because, maybe they give this to you to accept. There's lots of questions about what registered reps can do and what they can't do. And so maybe they say a registered representative can do all the following during the cooling off period except send out red herrings known as preliminary prospectuses. Yes. Accept indications of interest, which are non-binding on all parties. Yes. Can the broker dealer place a tombstone? Yes. And the D will be one of these things you're not supposed to do. All right. So listen, that concludes our lecture on that concludes our lecture on primary market for corporate securities, Series 7s. Reminder, make sure you get the municipal securities lecture done at some point. Rest of you, this is sufficient for you. So, now when I say sufficient, I mean, I'm assuming that you're doing other things besides watching videos with Dean, right? I'm assuming you're reading your study book and you're, doing your practice questions. You're doing all the stuff you're supposed to do in terms of executing your study plan. I'll probably put this up pretty quickly. I've been putting things quicker, publishing them quicker, just because people, say, hey, Dean, I'm going, and I feel bad that, they don't have as much of this. Put in your request. At this point, I'm kind of done in terms of what I, what I had my goal or agenda I had of arrows that I wanted to add to your quiver in terms of video lectures that could supplement your study effort. Like, share, subscribe. But, most importantly, moving forward, if you have something you like as a video lecture on the YouTube channel, put in your request, because until I get a request, I'll probably take a break. Anyways, bon chance, mes amis. Good luck, my friends. And I will see you whenever I see you.